Now, why is EMH so important is the next thing I'm going to cover. And then we'll move down to what's the situation that EMH should hold. There will be 3 different scenarios in that second part. The first part, why is it important? In 5 respects, I'm going to talk about it. So let's go. Essentially, this is a fundamental concept that is central to the neoclassical economic theories. You think about all different parts of the economics, but it really hinges on this market efficiency. If this breaks down, the rest of the part is almost like going nowhere, right? So that's why. Let's go. Number 1, right? Social planning. Number 2, who wins and who loses in investment. Number 3, risk sharing among investors. Number 4, incentive giving in corporate governance. Number 5, resource allocation among these divisions within a company are the matters, right? Social planning, let's go. First one, social planning, well, welfare, right? Social welfare, a central planner of the economy. Should we go for communist so that the central government will allocate all those resources? Good luck with that. Good luck, North Korea. Good luck, China. You guys tried it, Soviet Union, for 70 years. It totally failed. The human beings are selfish anyway. Nobody is altruistic anyway. So is there any way so that everybody can behave in their own selfish manner, in rational manner, to the extent they abide by the law, but selfish manner, and then can we allocate the resources in the most efficient way? Not to the most idealistic way, but to the most efficient way for the well-being of the maximum number of people. Okay? Adam Smith was the one who proposed that. The price mechanism in a competitive market is the invisible hand, right? That allocates the resources most efficiently. Participants behave rationally in a selfish manner. Don't worry. Be happy. The invisible hand will take care of you naturally. Okay? And what do we see? Oh yeah, Adam Smith over there. That's me visiting University of Edinburgh. Thanks to the invitation by Professor Ho and then Eshragi over there, my good friends. I had a lot of fun over there. And then social planning, right? Social planning. If correct, prices gives useful information about expected economic growth, discount rates, and risk or volatility. Pareto optimality, you can achieve it with best resource allocation. If you remember those general equilibrium concept in microeconomics basics. Bad price compromise business and consumer planning. So that's why price has to be efficient. It's important. And then it's informative about this economy. The stock price, those price information is 선행한다. It's like going ahead of time, right? It has some predictive power about the GDP growth and things like that. So this works, the stock market works like the thermometer of your economy. 체온계, right? It tells us a lot about the economics in the real world. Number 2, who wins and who loses in the investing, right? If prices are right, average investors cannot really make a mistake on average. Of course, you and I can make mistake, but on average, right? Mistake in a good way, mistake in a bad way, we don't know. As long as they stay diversified, right? As long as we stay diversified, we are safe. Higher risk will be compensated with higher return. Just tell me your risk preference. I will adjust your beta of your portfolio. Okay, so that you will achieve your expected return. Right, capital market line, all those things are there for you. And then, but if prices aren't right, unsophisticated traders who don't understand the game, capital or individual investors may lose money. More generally, irrational prices can arbitrarily affect allocation of wealth in the economy. So prices in the bubble, prices in the crash, it will screw up, right? Especially for the ants or what we mean by individual investors, right? Foreign exchange students, you should get familiar with the concept of ant in Korean terminology. 개미들. Your friends will tell a lot about ant. What do you mean by ant? That's me, you, every individual investors. Ant. Why? Those institutional investors are like elephant. Crush on you. So that's the thing. Has nothing to do with Ant Financial of Alibaba. Anyway. Number 3, allocation of risk across investors. Correct prices facilitate efficient risk sharing. If you are high risk takers, go for higher beta portfolio. If you are low risk investors, risk averse investors, go for risk free asset over there. The 국고채, like a treasury bond, or things like that. You adjust it accordingly. Low beta, high beta, or zero beta. If prices are wrong, then it's harder to quantify risk, right? How is the price informative so that you can test it that way? Okay, it screws up everything. And make good portfolio decisions. They're really difficult. Which is actually the key assumptions of CAPM is like not like that. There's no such thing as bubble or anything. Okay. If investors are unsophisticated and irrational, they may not diversify properly. So those guys will be in trouble. Number 4 is corporate governance. Right? Here, the efficient market hypothesis also matters. Isn't corporate governance like corporate finance? Yes. Finance is a subfield of economics as a whole. The whole umbrella of economics, there's a finance sub-umbrella, and then the corporate finance is sub-umbrella over there. And the governance is over there. And then, likewise, everything in the economics gets affected by the EMH hypothesis, right? Corporate governance, why does it matter? Before that, what is corporate governance? It's all about how to get my money back, right? How to get my money back. My precious money as a shareholder, I want it back. You CEO, don't you waste my money, right? By doing something fishy behind the scenes, behind your closed door, right? Well, the thing is, maximizing shareholder value, okay, is important. That's, what corporate governance is about. But the trouble is, separation of ownership and control is there. Okay, if the ownership and control is not separate, I myself am the 100% owner of the company, and then I just do it myself as a venture. There's no such thing as corporate governance issue over here. No governance issue. Because if you screw up your business, you are screwed yourself, right? But the thing is over here, ownership and control is separated so that the ownership belongs to what? The shareholders. Control belongs to the CEO, the delegated control, right? CEO, he or she has his own agenda, okay? What's his objective function? Okay, 목적 함수가 뭐냐? Objective function, maximizing his or her utility. Okay, maximizing his or her utility. I want to be happy myself. Life is about living happily. Okay, nobody rejects it, right? Everybody agrees. Shareholders' objective function is different. Theirs is, I want you to maximize my value, the share value, maximize the shareholder value. Okay. As a principal, okay, CEO is called agent in economics terms, and then shareholders principal. And then there is a principal agent problem, or the principal agent, okay, not a conflict of interest, but principal agent problem, okay. Delegation. What if the guy does something, lazy? He does not work at all, right? And screw up the business. Maybe smoking a crack behind the, closed door, then the shareholders will be screwed. Yeah. So is there any way to make these guys' interest aligned? Okay. Interest alignment is incentive alignment, I would say. Incentive alignment is a key issue over here. Incentive alignment. How? Giving some economic incentive, right? The CEO, if he gets some economic incentive, like what? Stock ownership. You, CEO, become one of us, the shareholders, so that once you work hard, Okay? The information that you work hard gets priced in the stock price so that the share value goes up. And we happy, you happy. We become happy, you become happy, right? 누이 좋고 매부 좋고 kind of things. So that's incentive alignment. Stock option is equivalent thing. You work hard, and the fact that the information that you work hard gets into price so that the shareholder value maximized, and naturally it makes us happy. It will make you happy as well. Incentive alignment. That's the idea. But the trouble is, what if the stock price is not reflecting the information that you are working hard? What if the stock price is not efficient? Okay? You will lose the incentive, right? You will lose interest of working hard. Let's play. Already the price is just in a bubble. Yeah, like KD Media in 2012, the company was in a huge bubble together with Gangnam Style. The Gangnam Style, if you remember YouTube sensation, like about 10 years ago, I know it's a long time ago, but with that, those Psy-related stocks were experiencing a huge bubble. The price was going up like 2 times or 3 times. KD Media was one of the jacket producer for the album of of Psy, right? So that but they had no other ongoing relation with the Psy. But with the past information about their relation, and then the Psy Gangnam Style going up, the stock price jumped up to like 2 times or 3 times, so that the guys in that companies lost interest of working hard. The CEO over there, emailed me and Johanna, I said, hey Andy, our employees, they have employee stock ownership, but they don't work hard because the stock price is already too high. No incentive. So I said, well, in that case, stock ownership or this kind of incentive really does not work. But maybe you should link the bonus to the accounting performances like ROA or something instead. The price has to be efficient so that for the incentive to work properly. Okay? So that's a key message. Number 5, why EMH matters in economics. It's because of allocation of corporate assets, corporate resources across firms and across divisions, right? Resource allocation. Correct prices facilitate efficient allocation of capital across firms. Well, this is, and let me go down to the next slide over here. 의선영, 죄송합니다. It's like yeah. If you remember the corporate life, right? Hyundai Motors, let's say, they have multiple divisions, right? I don't know how many, but combustion engine motors, and then electric vehicle, EV, the electric vehicle division, and then hydrogen motor division, and then other credit card or something like that. Okay? Division by divisions, right? At the end of every year, the CEO has to allocate the budget to different divisions, right? Billions of dollars game. And then internally, there's politically warfare going on among these division heads, right? Give us more money, and then, more budget allocation. Everybody fight for that money inch by inch like crazy. Struggling. But for the CEO, how should he, the 의선이 형 over there, 정의선, how should he allocate that limited resources called this budget? Based on Tobin's Q, right? Tobin's Q. This concept over here. What is that? Tobin's Q is a measure of how much the investors in the market evaluate the certain division or business, certain business, compared to its, for each dollar of investment already put in, Again, Tobin's Q is the concept of how the market evaluates for each dollar that was already invested in the past. Clear? So the numerator is always market value, okay? Because this is about how the market is evaluating market value of invested capital over here, let's say. And then the denominator is the historically invested amount, what is already stuck in. 박은 돈이 얼만데? 박은 돈 1달러당. It's like for each dollar of, invested, how much is it evaluated? You want this to be bigger number, which means Tobin's Q bigger than 1 means that for each dollar invested, the market evaluates more than $1. You're happy. Yes, we invested in a good project. It's much more promising. And as people evaluate this industry or this division's business more promising, this Q will be higher. Okay. On the other hand, if the division has no future or the industry has no future, the Q will be less than 1. So 0.5. Actually, the combustion engine business, conventional motor business, their Tobin's Q is like 0.5 or something. It's like, what? Why did I invest $1? It's only 50 cents worth, right? Loss making, crazy. Yeah, that's the situation. Okay. Electric vehicle, it's completely opposite, right? And then there comes hydrogen division, hydrogen car. I don't know the Q, right? But that's the Tobin's Q is a nice measure for that one, okay? And then the rule of thumb for here, right, is you allocate your budget to the divisions with the highest Tobin's Q, priority. More promising, investors are feeling, your division is sexy. Let's go there. Yes, put more money. And then if your division's Q is miserably low, restructuring time. Nah, not as much. Okay? And then we have to reallocate your labor force into there by retraining those guys. Retraining and those things, isn't it HR concept? Yes. In the end, those HR, we have to talk to the finance guys like us, right? They have to talk to us, right? We have to have this kind of understanding. The thing is, getting back to EMH, right? What if this market value is not informative? What if the market value over here is not a true value? Okay? Isn't book value the true value? No, that's very CPA style of answer. No. Okay? MV is something financial concept in the market right now, going into the future, forward looking. How much are they evaluating it? Okay? So the thing is, what if the future value evaluation is not correctly done? What if the market is in the huge bubble so that the price is not informative, not efficient, and it's exaggerated? Should you follow and then invest in that division? We call it overinvestment. You will lose money. So in that sense, the price has to be informative, which means the price has to be efficient for your resource allocation purpose. Make sense? That's the idea. Yeah. That's the whole thing.